well done to Cayman because he got the reaction right from yesterday. But we're going to talk about that. But I got it wrong. He got it right. Well done.
Thanks, mate. But it's not a race. It's not a race.
Of course not. No. We get some wrong. We get some right.
Yeah,
Depends on
And
your trades.
I mean, hat off to the one who really traded it, which was Ryan.
Yeah, it wasn't me.
Ryan, he went short dollar yen. That was a massive trade. Massive trade.
Yeah, cheers, mate. Good effort all round, which shows the power of the community. You know, lots of ideas, lots of thoughts going through, and give or take, we generally get it on the money most times. So yeah, we'll go through that in a bit. Going to actually start with the data just because there's been so much of it, and we'll just scroll back. Yes, I'll try and run through this pretty quickly. Because there is bundles and bundles and bundles. Oh, see, look how long it's scrolling for, all the way down there. Start with some of the key stuff. So USG, well, let's start with the ADP first. Came in a little bit soft, 127,000 there. Market took a little bit of a knock on that, but the overriding thought is it's still a positive number. I think we're going to need to see some negative numbers popping up before the market gets really screwy about jobs. This will probably be the last domino to fall as far as the Fed's concerned and those dovish in the market. GDP came in a little bit better, so not too bad, but that's moving further into the rear view mirror. The Chicago PMI, now for those that don't know, this number gets released to subscribers 2 minutes or 3 minutes before it's publicly released, and just about that time we saw the dollar dip by quite a few pips, and I happened to remark, oh, it must be a shit Chicago PMI that came out to subscribers, and lo and behold, 3 minutes later that number drops 37.2 versus 47 expected. Huge drop there, but it's only a small number. But as is often the case, the market sold it, and all those subscribers put their bids in below, and dollar went back up again. Then we got the JOLTS numbers. That came in, it beat expectations depending on what calendar you were looking at. But the important part of that is that it was still down on last month, 10.334 million versus 10.687 million prior. Now, underneath that headline, we get some other components, and the layoffs number, this is people being laid off, rose to 1.387 million from 1.329 million prior. So layoffs increasing there. That's something that falls into the Fed's view of the jobs market deflating, so to speak. There's another metric called quits, which is often looked at as a metric to show people who are willing to change jobs, move up the ladder, that sort of thing, leads to potentially higher wages if they're getting better jobs, better pay, becomes inflationary as well. It also shows confidence in the jobs market for people being able to move up to new positions rather than sticking in old ones. That dipped slightly to 4.026 million from 4.060 million prior. This had been rising as a trend for quite a while, so maybe a little bit of a pause coming in there. Pending home sales, not as bad as expected, but still another negative there. We know what's going on in the housing market. Some fun and games in the crude inventories. A drawdown of 2.758 million was expected. It came in at minus 12.58. So that saw oil rally about a buck and a bit on those numbers there. These numbers can be volatile as anything. Over to Australia, PMIs, a little worse than expected, still in expansion there. The AIG measure of manufacturing is still in contraction and worse on that side. Capital spend in Japan, 9.8%, decent rise there. There was also some data out from the MOF that all firms' recurring profits have hit a record high for the period of July to September. And that CapEx data reflects a gradual economic pickup, and the need to be vigilant versus the impact of price hikes and supply constraints. So that's some comments out from the Ministry of Finance there. Swinging through to today. Ooh, there we go. Let's have a look. Let's get some of the choice numbers. So another China PMI out there. This is more of a private survey one. Bit better than expected, 49.4 versus 48.9 prior, higher than the prior month, but still in contraction. Household confidence in Japan down a few pips there, 28.6, missing expectations. Where should we go? Retail sales in Germany looking a bit sucky there, deeply negative in October. We'll see if that picks up into the holiday period. Swiss CPI coming in largely as expected, year on year 3%, unchanged. The month-on-month number flat versus 0.1%. Obviously, eyes on the SNB in December, one of the meetings coming up in that busy week there. PMI in Switzerland down a tiny bit there, nothing really of note. Italy, a lot of these are final numbers past Spain. That was a fresh one. So a pip up there, still in contraction. Italy, still in contraction. France, contraction. You get the picture all the way through. But unemployment in Italy, a touch better there. And look at that. Greece still not as bad as it was last month. Are you feeling? Yeah, so as you go through there, the UK also ticked up a tiny bit, 46.5. It doesn't really matter. All these numbers are in contraction, so it's just things are less crappy than they were before. Right, I think that's covered all the data there.
Did you mention the UK house prices? That's an important one.
I haven't. I only keep half an eye on it.
It's okay, but nationwide house price index down from 7.2% to 4.4, expected 5.8. So this is a trend that we're seeing pretty much everywhere. The US is obviously ahead, I think, but housing is starting not to like higher rates with a lag, as always.
Yeah.
But higher rates are going to make refinancing and mortgages a lot more expensive, naturally. So a lot more housing supply out on the market, which drives prices lower. Yeah, and we saw some of that coming in, the mortgage approvals and mortgage lending stuff earlier this week. Maybe there's a bit of a knock on from all the shenanigans over the Quarteng Trust stuff when rates went ballistic and mortgages got pulled and that sort of thing. So that may need to play out a bit. But yeah, house prices in the UK probably going to fall. With the UK, it's a lot of things are very regional. So the southeast, South London, that sort of thing, you tend to find prices don't drop as much, or even they don't go up as much. They still gain, but not as much. It's some of the other areas that we see wider variations. But generally, it still points out there a bit of weakness coming in there. That's it from the data expectations or data we saw yesterday. Today, some of the data we're getting, obviously PCE is going to be looked at very closely. And what I'll say about this one is, and we'll talk about Powell, obviously, I'm not sure it hugely matters, the PCE right now. If there's a big variation, obviously it's going to churn markets around. But I think the way the market's set after Powell now is that anything that lifts the dollar, lifts yields, so higher PCE, that sort of thing, is going to get sold into pretty hard. The pivoters, the doves, whatever you want to call them, have got the upper hand right now. So it's going to be rally selling for any higher dollar moves, I believe, from here on in. PC is expected to dip a bit in the core year on year, one tick. PC itself is expected to come in unchanged. Now it should by and large follow the same trends as the CPI, but it's not an exact science. Just because CPI dropped
last month, a good chunk, doesn't mean PCE will drop as well. It's different metrics, different measurements. But if we're looking at the trend as a whole, we've seen CPI dropping 4 months on the trot now, and the core potentially turning. So PCE should at some point start to follow that. Whether that does today or not, we'll find out. If it doesn't and comes in strong, as I say, that may be a good time for traders to look at fading any upside dollar moves in that, because the market isn't going to let go of what's happened after Powell. Got a few other bits and bobs out, speakers and whatnot. Those in the Forex Flow, the ForexAnalytix chat room will know the calendar for there. Canadian manufacturing PMI, and then we start getting the US stuff, ISM manufacturing, S&P global manufacturing. So plenty to come later on. Right, let's get over to some of the headlines overnight. China, as always, the big deal at the moment. They reported just under 35,000 COVID cases, which was less than just under 37,000 yesterday. There's been some comments out as well from VP Sun over there. So they're going to, there's been a bit of easing in some of the regions. So regions or towns like Ganzhou, Chaoxing and Beijing are all easing up on restrictions, but it's not wholesale. The Jinzhou region or city in northeastern province is going to stick with zero COVID on the prospect of achieving a dynamic clearing in a short period of time. Work that one out. But this vice premier, who is apparently now in charge of all COVID stuff, said that they will promote implementation of optimization measures and ensure people's health and safety and economic and social development. Now, what they're also doing is they're easing quarantine restrictions as well. Beijing, for example, they're going to let some low-risk patients home quarantine. And in Guangzhou, there's going to be different testing for different people, and potentially no longer periods for mass testing. So it's all changing. It's all part of this easing stuff going on. We haven't heard outright that they're abandoning zero COVID, which I think is probably going to be the big headline to maybe look out for. But these little changes here and there, they're all adding up. So we're potentially on the road to easier restrictions in China, this reopening. We'll see how long that continues for. There's still protests going on. So, you know, there's still stuff bubbling under the surface there. Back over to Japan, and Bank of Japan's Noguchi, if I get that name right, said it's important to continue with easing persistently, and that wages must rise about 3% for the Bank of Japan's 2% inflation target to be met. The decision on when the bank will roll back stimulus would be data dependent, but looking at the data, doesn't think now conditions will fall into place to exit easy policy anytime soon. But depending on the data, the timing of exit from easy policy could be pushed forward. What do you make of all that out of China and Japan, guys? Well, let's start with China. We've got this easing coming on. It all seems just little bits and pieces, though, doesn't it?
Yeah, that's my impression as well. It's going to be a slow one, and it does look like the latest ones are just in response to the unrest that we are seeing over there. I'm not sure if the Chinese government is really ready to reopen fully, but they're just giving in bits and pieces to try and keep the crowds a bit quiet. That's how it looks anyway from where we are. It's always difficult to see what's really going on the ground over there.
Yeah.
But that's how it looks really. Because if you look at other big parts, they still, I mean, yeah, some people can quarantine at home, but if your housing block is surrounded by concrete blocks, you're still not going to work, like that, for instance.
Yeah, exactly. And what about the Japan stuff? Anything?
First of
it gives
all,
numbers, I think.
First of all, on the data, we are completely. They are like really up and down, right?
Yeah.
We saw a bit of a better data, then they got worse again. Now this capital spending in Q3, it's a little bit dated already. We could argue about that, but it's quite larger than expected now. And the profits higher is somewhere to be expected, because if your economy is based towards the exterior, the outside, and the yen loses massive value, as we have seen over the course of the year, your profits in yen are de facto going to be a lot higher. So I'm not having too much of an opinion about that. Noguchi, it's all like pointing to yeah, I mean, how long will they decide that inflation needs to go higher before it's a trend in their opinion? They're still all hiding a bit behind Kuroda. He's really going to be the guy who says yes or no to relaxing some of the measures. But I can't deny it makes the upcoming December meeting could be an interesting one in the BOJ, because it does look from the comments that there's going to be more discussion about relaxation of measures or possible changes, even small ones, to the wordings and things, and preparing for some kind of a withdrawal of some of the measures, at least, perhaps not the big one, YCC, but it does point that there's going to be anyway bigger discussions around everything.
Yeah, definitely. Stel, what do you make of the China stuff? Is it just appeasing the masses, or is it?
Look, Chinese government is always going to do what it wants to do. It's going to get the job done, whatever that is. And I think they are exactly what you guys said. They're trying to appease the crowds, give them a little bit just to make them go away, basically, right? Because the protests are there, but we've seen this time and time again, and it's not like it's we haven't seen this over and over again over the past months and a couple of years. So, at the end of the day, the Chinese government will do whatever needs to be done in their view. This zero COVID policy, I personally don't see how you can succeed ever in doing that. I think that COVID is going to be here forever, just like the common flu is, just like other viruses are. And the more you try to defend against it rather than let it evolve into something that's part of everyday life, the more difficulty you bring into your economy. That's it. And we've seen this. So anyway, I think I agree with you guys. I think it's just they're trying to appease the crowds and give them something, and we move on.
Yeah, definitely. Right, speaking of moving on, we shall move on to what's happening between Russia and everyone else. Apparently there was a headline yesterday that key EU nations are thinking about lowering the Russian oil price cap to $60. They were looking at the 65, 70 bucket area. They might lower that to 60. Russia came out not long after and reaffirming they won't sell to price cap nations. There was also comments out of Russia regarding Sweden and Finland. If they join NATO, it would force Russia to increase military presence in the Arctic region. They were also warning about the US and tensions in the South China Sea. There's undergoing military drills there between Russia and China. That comes on top of military drills between US and South Korea the other week. So they're all still playing with their boating toys around that region. Over to the UK. Apparently the EU is to raise concerns over the UK's free ports schemes. These are potential tax incentive areas around the country, free ports, to encourage investment and trade, and the EU are getting their hackles up, or the shekels up, because they think it might be anti-competitive. Well, up there's, as far as I'm concerned, they moan about things enough. It's in our hands to do what we like. The Bank of England had a survey out, a business survey out from the private sector, showing output price inflation amongst firms is expected to be lower. Annual inflation came in at 7.2% versus 7.8% last month. So possibly a little bit of relief there for the Bank of England in terms of firms' price expectations for output prices. So the prices they charge still running very hot at 7.2%, but inflation expectations is always a big part of central banks. And over to the Fed then. Let's go. Let's start with Fed's Cook. Said it's prudent to hike in smaller steps as the Fed moves forward, seeing some early signs of improvement in inflation data, but it's too soon to say whether the inflation trend is turning more friendly yet. And wage growth is above levels consistent with the Fed's 2% inflation target, pretty much reading off Powell's script. So over to the Powellster. Right, let's go through some of his key comments first. So the first comment out obviously was that he said it makes sense to moderate the pace of hikes, and that could come as soon as the December meeting. He said that substantial progress has been made towards sufficiently restrictive policy, but they have more ground to cover. He also said that it seems likely that rates must ultimately go somewhat higher than policymakers thought in September, and that they'll likely need to hold policy at a restricted level for some time. History cautions strongly against prematurely loosening policy, and that they're going to stay the course until the job is done. The October inflation data was a welcome surprise, but it will take substantially more evidence to give comfort inflation is actually declining. He also mentioned jobs and said that there's metrics around that suggest that around 100,000 jobs growth per month is needed to match the population growth. Few people are painting this as a bit of a target for the NFP, basically saying that anything 100k is enough, is the bare minimum the US needs. Anything less than that is a bit contractory. So we're going to probably use that as a metric going forward. He also said there's still a path to a soft landing. And one of his comments regarding that and jobs was also that something like JOLTS could in fact create the slower jobs strength, if you like, rather than seeing jobs absolutely cratering and in unemployment rising significantly. So it could wash out that this ratio between jobs on offer and unemployed could narrow, it could slow down. So we don't actually need to see big job losses and big falls in unemployment or big jumps in unemployment to get the Fed where they want to go. And that would indicate this soft landing path. Now, for me, Powell, I was expecting him to be much more forceful than he was. In my opinion, he pretty much kept the same tone, the same lines as from the last FOMC. There was nothing more, nothing really less. And that's what did for the market, I believe. Dollar obviously lower, yields coming down as well. We'll get a look at some of the prices there. Now, this was a bit twofold. I wanted him to be stronger, to give me better levels to sell the dollar at. As you know, I've been bearish the dollar for quite some time. I didn't get that, so I ended up jumping in pretty much at market, up at 138.80. I'm going to try and sit on that as long as possible. My Aussie dollar longs are doing okay with this break of 0.68. So I've been positioned for this this event, if you like, for quite some time. I would have liked Powell to have been more forceful, as I say, to give me some better levels to sell into, but that's life, and we trade on the other side. But yeah, I think Powell has given the pivoters now. I won't say it's dovish because I have a different definition of dovish to everyone else. Dovish is when central bankers talk about cutting rates, not moving from big hikes to less big hikes. So for me, it's still not dovish. He's given stocks a lift, obviously, because of two things. A, the soft landing comments, and B, because he's cutting rates down a bit further or not hiking as fast, which is what the market has been trying to push for all the way through. So from here, as I mentioned with the data, I think it's going to be a struggle to see significant dollar upside from here on in. We are going to get, obviously, the NFP tomorrow. Anything can happen. We have still got the FOMC, but I think it's all pretty much laid out now what's happening. We're going to get a 50 pip hike. That's more likely than not. Rate probabilities today are 90%, 91% for a 50 basis point, 9% for a 75. I was perhaps expecting that to switch around to pricing 50 25s rather than 50 75s, but early days yet. And the FOMC, likely we're going to get a 50, likely the ceiling's going to be raised, but the market is now sensing that we may not even get to that ceiling, the old one or the new one. So I feel it's going to be a tough ask to see any significant gains in the dollar unless something massively changes from here. And with that, I'm going to throw it over to you guys. Who wants to go first on that one?
I can go first if you want.
Go ahead, mate.
I am personally puzzled by this market reaction because what did we get? We got Powell saying they need to do smaller hikes. Well, we knew that already, right? Fed fund futures were pricing 50 and not 75. So this was confirmation that the pace is going to drop. But I don't understand what was so dovish, let's say, or so much of a surprise to the market to see this big rally and everybody saying, oh, this is the end and all that. Remember, if they hike 50, which I think they will in 10 days, 12 days time, whatever it is, we are then only 50 base points away from the peak in rates priced by the market. So we're pricing 5%, roughly just under 5% actually in terminal rate, and 250s will take us to 4.75 to 5% range, which is what we're pricing. So is that it? Will that be it? I'm not sure. I still think that we're going to see inflation dropping substantially in the first quarter of 2023, probably February, March, when we start comparing to the ridiculous rates that we were seeing, rates of inflation February, March of this year. So that will probably give them a little bit more ammunition to stop and to make it slower, the rate hikes. But I don't see what changed, what Powell gave us, which was new compared to what we knew before. It didn't. I
think you nailed it with the word confirmation. Remember, this is the first time he's spoken since the FOMC and since we got all that CPI stuff, and so I think his confirmation that he wasn't going to push or be more forceful, toe the line, confirm a 50 pip cut or move to a 50 pip cut. I think that's what's done it. The pure confirmation. The market. We've all been waiting for Powell since the CPI, the PPI, and all the rest of it. We've been saying about it on F.A.C.E here, how important this was going to be, and the market got confirmation that he's not going to be any more hawkish than he was at the FOMC, and they've just added to the moves we've seen since the CPI report, I think.
Yeah. Well, confirmation of something that's fully priced in. I don't see why the reaction. Anyway, yeah. But clearly, I don't get it.
No, I agree. I agree with you. And reaction. We can always question the reaction, but as we say, ours is not to reason why. Ours is but to sell and buy. So yeah, it's strange to me, but who cares? That the market's going to do what the market's going to do, isn't it? Kay, let's hear it.
Yeah. So as I said yesterday, it was a bit more mellow than previously. So as well as in his tone and how do you call it, demeanor when he was talking to the guy in the audience. So he was leaning closer to Brainerd than the rest of the Fed. members that we heard speaking, and I think that was enough for the market to react on it. Oh, hang on a minute. Yeah, I understand the market reaction. So to me, compared to how Powell could have sounded and how we probably were expecting him to sound, because it was also my base case for him to stay the course, his course, he was a bit more mellow than it. So yeah, that's where the surprise came from, if we can call it a surprise. And that's what the market reacted upon, like, as you rightly pointed as well, to the possibility of a soft landing, expectations now for this inflation to, well, we don't know, show a peak or whatever, but we are in a softening process right now. And all of that combined gave the market reason enough to buy, in a way, buy risk and buy stocks, and on the other hand, sell dollars. There's been a lot of correlation going on as well, but we have seen the US yields giving in quite a bit. So the market seems to be repricing a little bit the target rate now. Stelios was saying, like, we are a bit below 5%, but they were hinting at 5.25. If you start to go below, it's like they're shaving off 25 BPs. In FX land or in asset land, the dollar, it can be enough for some repricing of the dollar, and I think we're in that scenario right now. Are we turning everything? I don't know, because at the end of the road, we're still going to stay. It's going to be dependent really on what the data are going to show us. And so I read something interesting saying that we have to include the data in what Powell was saying, because if you look at this Chicago PMI, even if it's not a big number, it is. It has been a very, very good indicator in the past. It's like you compare some of the small numbers, but then all of a sudden they become like when you vote for something. If in a 25 people community, if 13 vote for one side, it doesn't mean anything on the national scheme, but they usually tell you who is going to be elected. You know what I mean? And the Chicago PMI is perhaps a little bit comparable to this kind of scenario. So I think the market was ready to sell dollars on any big hawkish stance from Powell. And then we had an extra springboard in the fixing, right? Because the last fixing of the month saw a lot of euro selling, sterling selling, dollar buying, dollar yen ticked up 150 points over the day, and then it all gave it back and more. So it's really, we have to take a combination of everything. He was a little more mellow, I would call it, not dovish, but than his usual self. So I think that's where the green light comes from for this dollar selling. And now, as I've been saying, also it's over to the data. If the data tell us that there is really slowdown coming, that's going to be then the dollar is going to get an extra knock on the head. And I'm especially looking at that dollar yen. Great trade, by the way, Ryan. And that dollar yen, there's what is it, like 200 points below here? We've got 200 DMA waiting. There's a bit of support around 135, 136, but why not? If the data really turns sour, why not go back to where we were only in July, August, right? 130, who knows? If the data hold up, though, then I think the dollar will also gain back some ground. But the data will tell us. And he said something interesting. So their models are saying that this afternoon's PCE should come out at 6 for the headline and 5 for the core. That's about what the market expects. So we can expect a bit of a move on the back of it if we show numbers which are not consistent with their expectations. And then, as you already mentioned, the famous 100K on the NFP. If we recall a while ago, we were talking about those NFP. I don't know whether it was on the Flow Show or whether it was just in our room. But we were talking about, we used to have this benchmark of around 200,000 job creations needed to be positive or to create growth in the job market, and below 200 could be a bit of a destruction. But now, and then later on, and that was over the Trader Summit, and I asked somebody about it, I think, who said the number is closer to 60K. But then yesterday he came up with a very interesting number, which is 100K. So I think that's a very, very interesting number that he gave us there, because that's going to be our benchmark now to measure whether the job market is in creation or destruction of jobs. And so tomorrow could be a very, very big number, a market mover, especially that we are still at the start of the month, that we just had the Powell, that we just had like weak PMIs and things. And it's going to be a big one tomorrow, in my opinion. So that's about it for the time being. I'm not going to say that I'm going to look for dollar dips to buy into, but I'm pretty happy to keep silver, my long-term silver longs, monitoring the situation in China for that as well. If they keep on big restrictions, I might reduce my long-term longs a little bit. We are in an interesting zone here between 22 and 22 and a quarter. And for the rest, I'm watching the show a little bit. Missed the move on the dollar yen for the better part, but yeah, it is what it is. And as I always say, it's better to miss one than to take it up the later hose, right?
Yeah, no regrets, as the tattoo says, no regrets. But yeah, I agree with you. You know, we're going to have a bit of a level coming into this 136 area, down into the lows. We have been through it, down to 135.83 according to my sheets there. So we have got a bit of a level coming in here, this area that was quite a significant resistance area on the way up through June. We did have a bit of a breakthrough, but then it got back under, held under, you know, talking maybe 135.5 ish. And then that took us a next leg up. So it's going to be a big area here if we come through. And as I say, I think dollars a rally sell from here, just the way the market's leaning right now, until something changes. So even good data, I think, is going to get hit. Good data, I mean positive, like positive NFPs, I think is going to get hit as well. But what will be interesting to see is if we get a good NFP, what stocks do with that. Because if they're being half bolstered by this soft landing talk, i.e. the economy is not going to crash as much as expected, then in theory, a good NFP should be good for stocks now, wouldn't it, guys?
Well, I mean, it's that thing as well. I mean, there's a part of me which fully understands the lower dollar, higher whatever, the correlation indices and stuff. But if you're manufacturing I know manufacturing is not the biggest part, but let's say if your real data show weakness, I don't see why stocks should really keep the bid. So if your economy starts to really sputter, we could be in the case where the correlation inverses, right? Where you see a lower dollar and lower US markets in favor for other markets. But the thing is now, what is the favor for the other markets? If the US sputters, how is it going to go in other markets? So Yeah, going forward, it's going to be an interesting watch to see if this correlation inverses, if the data really start to turn for the worse. I mean, so in my opinion, we should not rally much further if the data really come off.
Yeah, as you can see there from the S&P, the level looks clear enough to me. What we've got to get above to get and carry on this move. If we fail to do so, then we're potentially going to continue this stepping down. But I think more likely than not, we're gonna shift up, maybe up to even 42s, possibly 43s. We'll see what happens, whether Powell has really given it Santa's rally. So I think that the dollar is going to remain bearish from this point on, but we need to look at the levels. You know, what has the dollar got to do, or what has other pairs got to do to move us to new ground? Euro dollar, clear as a nose on your face what it's got to do. 105 is your number in that one. If it's going to kick off, if the dollar's really going to sell off significantly, that's the level that's got to break. We've had a couple of attempts. We'll see if we're going to get another one. I'm going to start maybe getting interested in looking potentially at a break long here. I might try a small short. I don't want to step too far in front of the train. So I'll be looking maybe for a small short right close to 105, maybe reverse that at somewhere like 105, 15, 20 into a long, see if we get the break there. But if we can't hold there, then potentially we're going back in the box and we're staying in this sort of 102s, 105s region, maybe until we get the next lot of central banks. Year-end liquidity is going to drop off. And maybe we have to see what happens when we go into the new year. But these are the levels we've got to look at. Mentioned the one on dollar yen. Aussie dollar, we've got to break above the 68 handle. At last it's been coming, and now we've got it. Let's go into a bit of a shorter one. But we're trying to hold the break at the moment. It's not looking decisive. I would have liked to have seen a much more solid amount of support coming in this break, you know, got to up to 68.40. I've actually gone in addition to my current longs, my core longs, 68.06, just to see if this holds. I've got to stop just below this prior low here at 67.75 is my stop. If I see it holding below this 68 handle though, and maybe below 90, I might just chuck it in altogether. What I want to do is play a bit of it on the short term, see if we get another move up back towards these highs, knock a bit out, then fold the rest into my core long. So again, a key level, can we hold this 68 area and push on up? If we can't, we're going back in the box, and there's more work to be done. And that's the way you've got to look at some of these trades. You can't just blindly say, right, we're off and running, I'm going to jump in, close my eyes and go with these breaks, go with these moves in stocks. You've got to trust the levels and let the levels be your guide. You know, here we are looking at gold, getting up to that area again that we touched previously back in the middle of November, up to that 1780s region, still below that 38.2 fib, 1789. We've run into trouble. We've hit our head again. We've come off again. You know, these moves are key for trading. You've got to respect these moves. They're going to tell you whether you're going to kick off or not. If you were long up here 1770s, you've got to be wary of this high. If we can't get above it, you know what's going to happen. The clock ticks, market doesn't break it, it's going to come back down again. So a lot of questions need to be asked of this. I know there's a couple of questions in there. One from our mate Charlie asking about Aussie Kiwi again. So I'll let Kay take that one. Dollar one, looking at this, I left a couple of orders in overnight from 702.50 down to 700.50. Only some smallish orders because there's obviously a strong wind blowing here in terms of the dollar side of things and China easing, but I wanted to play this big 7 level. We've got designated support down here already, so I got filled on one of my orders down here. and it's bounced from there. Again, look at what levels it needs to get through. This 709 area, 710 area was a level on the way up. It was a level on the way down. Now it's here again. You know, are we going to move all the way back up? Got to get through this 709s, then the 1012 area, then maybe on we go. I'm not too sure we will, so I'm going to make sure I take plenty of profit on this one if we get further moves higher. So yeah, play the levels. That's the biggest thing I can say for today regarding what's going to happen. Watch the rest of the data, see what comes of it. Kate, I'll hand it over to you.
Yeah, okay, thanks, mate. I'm going to take it backwards for the questions. Let me just share screen. So the last question was by and Sorab, the dollar mix. Right, dollar mix. 1940-41. That's our first level to look for here. I still think that if we look at the more medium term, for the time being, the harm is done. We're through this red line from 2017, comes around 1965. As long as we stay below, and you see a few more trend lines here. So this is going to be the area. I think 1965 allow for an overshoot to 75 or so, 75.80. That should be the area now that caps it. Otherwise, we could be getting back to above 20. For the rest, we're still in this downward channel. I think nothing has changed so far. But as I've been saying many times, I'm trading a lot of times. I'm trading stuff like a block, and for the time being, I don't know where dollar mix is going to end up. We see dollar weakness, but then we see the dollar mix, and to a certain extent the dollar Canada stabilize a little bit more than the rest, because they are neighbors, and I always like to have an element of trading it as a block. So for me, dollar mix could stabilize a little bit around here, but the overall trend is still lower, especially if the US slows. But then Mexico has already told us that if the US slows, they would slow as well. But we still have a 10% currency, so I can't be really short mix for more than perhaps a blip or two. If we get back below this 1915 zone, I think then we can have a test of the next one. Still think the ultimate move is going to go back to around the pre-pandemic levels, also helped by the interest rate differentials, but also thanks to the proximity of Mexico. And as already mentioned a couple of times, and I think Blake also mentioned that some of the Chinese activity flew back into Mexico, so that should somewhere still be supportive for the MEX over the medium term. And then Aussie Kiwi, we looked at this yesterday. We're looking at it again today. Yesterday I told you there's a possibility that we are going to test this 107.1040 zone. We are in it. To me, the point of no return is around 106.65.75. That's where the point of no return is. And there's still a bit of uncertainty around the Chinese openings, as we have been saying earlier on the show today. So I reckon in the meantime, the kiwi is still a bit more of a fruit full of vitamins than the Aussie. Is it ready to turn? I really don't know. And I gave the levels, and I'm going to observe the levels. My gut feeling is that we are going to start to slow down and perhaps correct a little bit. But as I've said, to really get going to the top side, we have to break 108.50.80 again here, and then we are going to to gain some traction. For as long as it stays here, I'm not really in the mood to catch too many knives, because my sentiment has been more positive Kiwi than Aussie of late, and I've got a little bit of difficulties to let it go unless dollar China dumps below 7 or 6.95.7 the figure. Ryan already showed it, but just to confirm those levels, we've come back here. You had like some stellar entries lately, Ryan, on your stuff, because I was trying to bid it 702 and below, and I didn't get any. So
you know what? I originally set up my first bid at 702, and I thought, no, it's a bit of a level down there.
Yeah,
we got down to 702.
Yeah, 38 or something.
Yeah. So it was, the last high was right on 702.010 or something like that. So I thought I'll stick it.
Yeah, I have it as just 702, but yeah, I was trying 702, and then in
this one makes up for my stop on the Euromix.
Yeah. Oh yeah. So yeah, the levels are still there, and as I was saying, to me and that hasn't changed. The level of no return is going to be here below this 696. If that goes, then we're talking about a different scenario. And if that goes, then I think the Aussie Kiwi has a chance of starting to reverse. That is a base idea. Oh, I want to have a look at this euro dollar ZAR, because there's been this massive rally overnight, and then my eye fell onto something that's been going on in South Africa over the past couple of days, and it seems that Ramaphosa, so he cancelled his parliament appearance today, because he is having to respond to an independent panel finding that he may have a case for impeachment over what is it, bribes or so, or theft at a farm. So be careful with what you do in the dollar rand, because we know that politics play a big role over there, and dollar rand just jumped 3% or so overnight on the back of it. So be careful if you have any rand positions. Personally, I'm going to steer away from all of that, especially if the president is at the presidency is at stake over there. Right. Quickly the metals. Silver rallied a bit above these 22 and a quarter. There's another level here around 22.40. We went to test it, and now we are back below this little trend line, but we are still above the 22 level. This is a bit of a zone for me. I'm going to decide what to do with my long term, and I might slice it off if we get back below the 22 level at some stage. It's I'm still, as I was saying, for this really to go, we need the economic data to actually hold up. They may slow down, but they need to hold up, because if you get like slower manufacturing data in the States, for instance, this afternoon, this thing could actually, despite a lower dollar, could start to sputter a little bit and perhaps not go as far as expected. But anyway, as long as we're above now 21.35, and I guess the 200-day moving average is still not far from there. Where are we now? 200 DMA, yeah, 21.32. As long as we're above there, I think it's still relatively positively oriented. Ryan, you already covered gold. We need to look at the yields. First of all, let me look at the short term, because yesterday, so we had this, what is it? This is the CPI dump. Then we started to get back up above 450 on the 2 years, and we're holding there. I still think this spike was a mistake or a fat finger. But yesterday we got a serious knock on the head, and we couldn't re-enter, as we can see here. We retested a little bit, retested again, and we couldn't re-enter the channel. And little bit of a repricing here of the terminal rate, perhaps, as Stelios was already talking about earlier in the meeting. But keep an eye on this. If we start to get back below 4.25%, I reckon in the short term, the dollar could get another knock on the head. But we have to monitor yields, really have to monitor yields. And on the 10s, we are in the danger zone here. We're hanging just above 360. You look at those lows from October, around call it 356, 355, really. If this afternoon data, tomorrow's data, put this thing below here, that's going to be another trigger for the dollar suffering. Okay, if in turn the data are a bit better and we start to get back into this zone here, call it like around 370 up to 380, I see more stabilizing dollar trade ranges, and we need to get back above 385, 390 for the dollar to really pick up steam again. But can it be done for now? I have my doubts, and really until the FOMC, until the FOMC, I really have my doubts if we can make it back above 385, 390, and that would go into a dollar rally scenario, which I think the market is in now indeed. So if you get any push up to 380 back on the back of data, you will see in the process the dollar regaining strength. But be careful here, because I think that around 380 we will have people sitting there, and per correlation rally sellers in the dollars. And really, I'm going to give it back to you, because you looked at most of the other currencies. Did you? Sterling, perhaps?
Yeah, you can grab cable, mate.
Yeah, the cable. So we're talking this cable, the 200 DMAs here, 121.50. Also, it's also a prior high. Sorry about the messy my charts, but it's also a prior high. But we could have an overshoot to around 122 and a quarter, perhaps, on dollar weakness if we go and test the high of the channel. Watch 121.5. We are turning around on a close today, and a close probably of the week as well. We can safely say if we are above, we could see this push up right into the 122s, and then we are talking about the prior high, which is only August, around 123, the figure as well, which is not going to be far away. On the downside, zoom in a little bit. On the downside, yeah, first little level 121.10, but this is too close now to the market. 121 the figure, and then keep an eye on this little one, which broken, retested, bang, and then we jumped higher. 120.60, 120.55.60. That's your first decent support, I would say. If we start if we go and retest and go higher again, nothing will be changing, and we could get this push higher. Get below, I think that smells a bit trouble, and then we could be on our way back to below 120, in my opinion. So that's for the cable, and I think the rest, Ryan covered it pretty much. Dollar, yen, euro, dollar, 105. I've got a 105.19 in there, so take 105, 105.20.
Yeah, thanks, mate.
Back to you.
No problem. Just want to pop in the comments there. Don't forget to enter our non-farm payrolls competition, which is up and running now. One of 3 lucky winners can win a free month on the ForexAnalytix platform. You come and see all the goodies we have to offer, and come and see us all in the chat room. Get to talk and speak to us and trade away and see what we've got going on. For me, just quickly on cable, just to add a bit to what Kay's talking about, and just take a bit of a wider look. Got a big area coming up in the 123s, starting from about 120 to 75, 80-ish. These series of highs here was the prior high before we got the swing down to those lows down there. 123.05, 03, 04 is the 50 fib of this move from 2021. So a big old area up here into that 123 zone. Just to highlight, there's some fibs there as well. On that note, I think we'll call it a day. It's been a long one. It's been a long week, and there's more to happen today and tomorrow. So as always, thank you very much for coming to the Flow Show. I hope we're giving you plenty of information. Feel free to let us know if we're not. Feel free to let us know if you have any suggestions about the show. You can use the various contact buttons on ForexAnalytix, on forexflow.live, here in the comments as well. Obviously not now because I'm just about to close it. But do let us know any things you want to see, anything you feel we can improve on. We're all ears. This show is here for you guys, not just for us to go blathering on for an hour. So enjoy the rest of your day. Trade well, trade safe, and we shall see you bright and breezy tomorrow. Thank you very much.
Have a good day.
Cheers, Kate.